In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
Hey, good afternoon once again, Market Rebels, and to all of our YouTubers out there. And we're back with Coach's Corner, another good show to help people with here today. A problem that we hear a lot of, don't we, Stu?
Oh, yeah. Big
and
problem.
We got a nice little rally, a little back-to-back. We had, what do we have? CPI came out 0.2 versus 0.3, still within the range. That was on Wednesday. Today we had jobless claims. I think it was 237 versus 249. But again, everything's kind of pointing to the upside. So we're just
going in the right direction, but they want
going in the right direction, at least if you're on the long side and rolling up and out and all the strategies that we like to help people with. But today, what I thought we would do is, and I know you get this a lot, Stu, where people, they get so confused on about what is the price of the option.
What am I really paying? Too many times.
What am I really paying for the right to walk away? And there's a particular problem when it comes to call options. And this is one that everybody gets wrong. And so we thought, you know what? Let's not let them get it wrong anymore. Let's help them with their decisions. And so that's what we've got for you lined up today.
And it's, it's part of like a mystique about options. Oh, it's $20. It's $20.
Yep.
Man, that's an expensive option.
That's an option. Not
really?
necessarily.
Well, maybe it's one of the cheapest things on the board.
Might be dirt cheap.
Might be dirt cheap.
Once you understand what it is you're looking at.
What
and
as
we always,
yeah.
Right. As we always tell people, traders, that if you don't understand the pricing and the things that you're looking at and measuring, how can you make good decisions? And so that's what we want to help you with here today. So for anybody who's new, we like to start off with a little segment that we call Chalk Talk, a little kind of just looks like a innocent little question, but they're always meant to be a little bit of a brain teaser, make you think. We want you to jot down your answer, and then at the end of the presentation, we'll come back and revisit it and give you the answer. So here we go.
And that's a literally write it down, because that forces you to
commit to it. So here we go. Stock at 100, interest rates 5%. We've got a 1-year $100 call trading for $5. And the question is, how much is the option? I know you know where I'm going with this.
Yeah.
So
Kind of
we'll
looks
see.
like $5, but we'll see, right?
Well, let's at least give them that. All right. Let's tell them that that's not what it is. That's what everybody thinks it is. And if you think that it's that, you're in good company. Everybody gets it wrong. But we want to show you why. So if you think it's 5, go ahead and cross that one off and take another stab at it, and then we'll come back at the end.
Is this a little bit of, is this like have a little bit of like price versus value in it somewhere in here?
Oh, we've got a lot to do with price versus value. Yep.
Yeah. 5 is the price, guys. 5 is the price.
Yep. 5 is the price you pay, but don't confuse that with the amount you're paying for the option.
Or what are you getting? Yes.
Right. So let's talk about that. How much are you paying for the call option? We've emphasized call option because we're leaving puts out of it for today, because there's a particular little wrinkle with the call options that, again, everybody gets wrong. And if you're not able to separate these parts of the value from the options, you're going to be forever making bad decisions. All right, so here we go.
The put side's a little, we'll get to the put side at a different point.
Yeah, well, I think we should do that at a future time. That would be an interesting one too.
It's it's a similar idea. It's just kind of going the other way, but
flipped over, which is typically true, right? Between the calls and the puts.
Yeah.
Okay, so here we go. This is where most people start. Intrinsic versus extrinsic value, also called the time value. Let's say we have the stock at 105, the 100 call trading for 7. Now, most people know we can break that down into 2 parts. We have $5 of intrinsic value, and that's found between the strike price of 100 and the current stock price of 105.
So little sidebar here. Look, people, don't try and memorize these formulas.
Right.
Always, this one, but just remember, it's just the difference between the two. That's it. Calls, puts, that's it. It's just the difference between the strike price and the stock price. That's it.
But you have to be careful. You have to be careful as long as it's not an out of the money option. Because if we have a 110 call, you can't say it's $5 in the money.
Well, that's assuming that we're talking about in the money option, of course.
Right.
Yeah.
But to know if it's in the money, you got to know the intrinsic value. So the other way you can think of it is if you have the right to pay 100, which is what a call option is, and the stock is currently at 105, that's a $5 benefit to you. You're better off by $5, and of course, you're going to get charged for it. Nothing's for free. So that's the $5 of intrinsic value.
Because what, Bill? Because it really goes back to the basic fundamental of what an option is. It's the right to buy the stock, right? And it's at the strike price. If you have the 100 strike price and you have the right to buy the stock at 100 where it's trading at 105, well, that's $5.
$5.
And the market is not interested in writing anybody a check. So the option, so the value of that option is going to start out at being $5.
You got it. That's a bare minimum. But the option's trading for 7. So there seems to be $2 of unaccounted for value. And so we just lump that into another category of extrinsic value or time value.
Isn't that the market makers trying to rip me off?
That's what everybody thinks. But we also know that if you add the intrinsic and the extrinsic value, also called the time value, that they have to add up to the option's total premium or the total price. So this is where people start. What we're going to show you is that this is really, it's an okay starting place, but it really misses some of the finer points. But let's take a look at the intrinsic versus the extrinsic. The extrinsic value of an option is really what makes it an option. That's your insurance policy. That's how much you're paying for the right to walk away. Okay, so always remember that with an option, you are never required to exercise it, even if it's in the money. If it goes into expiration day and you forget to exercise, and you didn't want to you didn't want to exercise, it went into expiration, you don't want to go through auto exercise, you can call the broker and say, I don't want to exercise. You are never required to exercise it.
Yeah. Suppose they come out after work.
Benefit.
Oh, by the way,
you
have to restate our earnings for the last 5 years, and the $107 stock is now trading at 84, and you have the 100 strike price. Well, you're not going to exercise it, right? It's going to look like an auto X, but you need to make that call, and you gotta check off do not exercise.
Right. So that's always a benefit. And you have to remember that it's always a benefit to say, you know what, this doesn't look like such a hot deal for me. I don't want to exercise. Well, anytime in the financial markets, if you hear the B word, benefit, you know you got to pay for it. Just like with the intrinsic value. Yeah, it was an advantage to be able to pay 100 when the stock's at 105.
Bill, do you
But
have
you're not going to get it for free.
Do you have that right if you own the stock?
Do not.
You do not.
You own the stock, right? You're on the hook.
Right. So if during the day they put the goose eggs up and the stock gaps down, you're not going to really have an opportunity to sell it on the way down.
It's always funny when people say, "Oh, that's never going to happen to me," because I watch it closely.
Yeah, you watch it stop trading.
You see if your eyes can stop a trading halt.
Yeah, it's not gonna work.
It's not gonna happen,
right?
And those do happen.
Or even if it is trading, right? Even if they don't put the goose eggs up, and even if it is trading,
and it goes off a cliff.
It starts falling off. You know, when you put it out there and it doesn't trade, you put it out there and it doesn't trade, and you put it and you keep chasing it all the way down, and you don't do it. Or how about if you have the stop order in? I love those stupid stop orders, right?
Yeah.
You stop order in, and it does gap down, and your stop order is at the market, and it opens up, and the stop gets elected, and bang, you just sold it at 84.
Yep.
Great.
Nothing guaranteed with a stop.
Yeah.
So the thing to understand is that the intrinsic value has nothing to do with the option. In the previous example where we saw there was $5 of intrinsic value, that is not your option. That's just cash. Cash in the options world is not the least bit interesting in terms of trying to figure out the option. All right, so that's the thing that we want to make very clear right now. The extrinsic value is the option. That's your insurance policy. Intrinsic value is just cash. Now, for anybody who might be new to our channel, first of all, it's great having you here. But if you're looking for some good information, especially free stuff to help get you started and good information, please check us out at marketrebellion.com/get started. Lots of great videos and information for you to get started with options. So now we've done this before, Stu, but I thought this would be a good presentation to bring it back. We've used this analogy many times in Q&A. Let's say you're walking in an antique store, you've got this vase, and there's also $100 bill inside
that you could see. You could see,
and you can pull it out. It's not like it's blown glass into. It's just sitting inside the vase.
Yeah, we're not playing Monty Hall.
Right now, forget about whether this would really happen in the real world or not. We're just saying this is it. So the question is, how much is the vase? So you look at it, and there's a price tag hanging on it of $120. So I want you to think, if you bought this, paid $120 at the register, you walk out of the store, and somebody says, "How much did you pay for the vase?" What would your answer be? Well, if you think about it, yeah, on one hand, you paid $120. That was the price to walk out of the store with it. But 100 of that was cash. If you just smashed the vase and walked, you've got $100 coming back to you. And that's guaranteed. So the real way to look at that is to say, okay, yeah, there was $100 cash in there, but that's not really interesting. We know it's got to be worth 100. What's interesting is that I had to pay $20 over cash. And that's actually where the word extrinsic value comes from. It's the value over and above cash or outside of cash. And
it's what we referred to on the floor. It was always referred to, how much over is it?
How much over?
Somebody comes in to buy an option, and one of the first things you're looking at is how much over is it. It's really measured by the implied volatility.
Yeah, but that's the only thing that's interesting. I know you and I have done that many times at lunch. We'll sit there and you'll tell me about an option that you bought that might be 20 points in money. You say, "Oh, I paid 75 cents over."
Yeah.
Well, I know he didn't pay 75 cents for it. I know he paid 20.75. I can figure out the cash value. Yeah. Again, that's not even remotely interesting. I got it. What I want to know is, how much did he pay over and above cash? Because now that's where the option lies. All right. So keep that in mind. This is a good analogy to help you understand the cash value.
So so you're buying the option, right? Think about that. You're buying the option. You're buying the option to get out at that strike price.
Correct.
That's what you're buying. You're buying
the insurance policy
to just say bye boy. Yeah. We're out.
Here's another reason why I say that cash isn't interesting. Stu, let's say that we're in this antique shop and you go, there's no price tag on it. You go, I wonder how much this thing is. And I go, well, I'll bet you it's at least $100. How much information did I give you? Nothing. Right. He'd say, thanks a lot for that. We know it's worth $100. And it's the same with an option. If your option's 20 points in the money, yeah, we got it. It's where there's 20 points of intrinsic value. That's not interesting from a decision-making standpoint for the option. We want to know how much over and above the intrinsic value. All right, so now let's get to the call option. Let's say that our stock is $180 call trading for 21. So here's a question for everyone out there. How much is cash? What's the intrinsic value there is $20.
Difference between
just like we could smash the vase and pull $100 out. I could buy that call, exercise it, get the stock worth 100, turn around and sell it and pull $20 out of it. Sometimes you'll hear it called the meltdown value. Just like with coins, if you've got a gold coin that's got an ounce of gold to it, we know it's worth an ounce of gold. That's the intrinsic value. And just like this, we know you can melt that down and get $20 out of it.
Moneyness. I think some people refer to it as moneyness.
Absolutely. Yep. So the bigger issue, the part where it gets interesting, is how much over and above cash are you paying? Now we're paying $1 over. There's your option. And most people would say, oh, it's a $21 option. No, it's not. It's $20 of cash, and it's $1 for the option. You're paying $1 for the right to walk away.
And that's the sunk cost, because there is 100% chance that one is going to zero.
Correct.
No matter what the price of the option eventually turns out to be, that one is going to zero.
Yep, absolutely true. So we've also shown this slide before, and I think it's a really good, I think this is a fitting presentation for it. But people miss this, Stu, and they say, well, why would I pay money over and above cash just for the right to walk away? Well, think of it this way. Let's go back to our horse race example. You can place your bets right now before the start. Or what if the racetrack owner says, you know what? I'll let you wait until the horses are halfway around the track. Same odds, same everything, but I'll just give you a little more time to think about it. It'd be an awesome advantage, because maybe you're going to bet on this horse down here, coming in dead last, and go, you know what? Maybe I'll walk away from it. Mm-hmm. So yeah, that's a huge advantage. We get to see when we buy the option how the future is going to unfold. So in a lot of ways, when you buy an option, it's a little bit like having a crystal ball. Let me wait and see what happens with the stock, and then I'll make my decision.
Here's a real life example. Excuse me for looking to the right here. It's my long story, but my screen's over here. Nvidia was up $20 today, $21.
I know.
5 to be exact. The 455s, which at this point are $4.77 in the money, are trading about $7 ish.
Wow.
Right, that's about one and we'll call it one and a quarter or so, right? Mm-hmm. Four and a quarter, about one and a half. What did I say? 7, 1 and a quarter, about 1 and a quarter of extrinsic value. Now that's not what, and you might say to yourself, why am I buying that? Well, because this stock was up $20 today.
Right. It could, right.
Right. You're paying no guarantees. A total of 6, 4 3/4 of which is intrinsic or cash. The balance is sunk cost. Well, this stock could be down $20 tomorrow.
Easily.
Right? 20. Can it be down 20? If it's down 20 and I'm long the stock, I'm going to be down $20. If I'm long this option, and it goes down $20, I lose my cash value, which is the 4 3/4, and I lose the difference of the difference, which is the extrinsic value as well. All in all, did I lose? Yeah, but I lost owning the option. See, you bought the right to say I'm out at 455.
That's right.
At 4 double, you get the option, no pun intended here. Well, actually, pun intended, to say, I'm out. That's it. That's it. You want to hang around being long the stock? Hang around. I'm willing to pay $1 and change to have the right to walk away.
Right to walk away. Now,
that's what people forget. See, they're connected. People forget that you're trading the stock. You are trading the stock. Don't forget that. You're just using an alternative vehicle to trade it.
That's exactly right. Okay, so now that we've broken down this intrinsic and extrinsic value, let's take the next step and show people Where the confusion comes in with the call options.
That's not Roscoe.
It's not right, but it kind of looks like him, doesn't it? He has that same expression. He has that same expression all the time. So let's take a little deeper dive and find out the way that a professional trader would check out the call option. So the extrinsic value for call options, again, is more than the right to walk away. It does include the right to walk away, but it's more than that. For a call option, it includes what's called the cost of carry on the exercise price. So take a look at this. Go back to our previous example. Most people learn to break an option down into two component parts, intrinsic and extrinsic. Professional traders are going to say, well, yeah, technically, Stu, there's $2 of extrinsic, but part of that is for the volatility, but there's also a part that is for the cost of carry. This is the part here in yellow that everybody misses, and it causes great misperceptions. So to understand the cost of carry, we got to backpedal a little bit, talk about some accounting terms, some finance terms called present value and future value. Super easy. Here's the way it works. If you got $100 cash in your pocket right now, that's the value now. It's at the present moment. But let's say that the interest rates are 5%. We would say the future value of that money is 105. Because you could deposit it, let's say, in a CD, pick up 5%. It's not worth 105 now, but it will be worth 105 in the future. We can work this process backwards and say, well, if somebody owes me 105 in the future, what's it worth today? Well, if we multiply going left to right, we could divide going right to left. I'm going to divide by 1.05. I can say that would be worth $100 today. I should be willing to accept $100 to settle that debt. Why? Because I could invest it at 5% and go right back to the same 105. Just two different ways of looking at the same thing.
Same thing.
Whether you're looking at it today or in the future.
Look,
all right, so now
everybody out there knows this isn't anything new, right? You got $100, you get 5% on it. Now you got $105. That's it.
Right. But we can work the process backwards. That's the thing that a lot of people do miss. We can work it backwards and say, go from the future value to the present. So now let's talk about the call options minimum value. Call options have to trade for at least what's called the present value, today's value of the exercise price. And that's because the exercise price is the amount that you are technically borrowing or floating.
Quick time out. So sometimes, in fact, all the time, I think when you're trying to do some homework and looking things up that have to do with the value of options and parity and all that kind of stuff, you're going to see the term PVX. And that's what Bill's talking about. Today's present value of the exercise price. It's really the present value.
I'm sorry, but I can't help with that
Alexa's
yet.
talking to you.
Oh my God, what was that? All right, sorry everybody.
So, but that's exactly right. So this has nothing to do with the option, just like intrinsic value has nothing to do with the option. So take a look at this. Here's our timeline. Here's 1 year out. One trader buys the stock for 100. The other guy buys a call option, let's say for $5. In 1 year, if he chooses, he could exercise and pay the 100 then. Notice that both traders paid 100. It's just that one paid it today and one paid it a year from now. Well, again, that's a benefit, and you've got to pay for the benefits. So what's the cost of carry at 5%? Well, the future value is the 100 strike times 5% or $5. The present value, to bring it back, we have to divide by 1.05, which is 476. Now we could check this by saying, theoretically, I could deposit 476 into a bank at 5% and have the $5 future value. So what does that tell us, Stu? Tells us that this $100 call absolutely must be worth at least 476 for the cost of carry. It has nothing to do with the intrinsic value, has nothing to do with the extrinsic value. It's a completely separate thing that everybody misses. And we're going to see why that causes a problem here shortly. So again, quick reminder for everyone, please visit us, marketrebellion.com/get started. So let's put this to...
Can you go back 1 second? Okay, look. If you could buy 100 strike price call that's a year out and pay 476 for it, think about your choices. You're buying the right to buy the stock. You can buy the stock, or you can buy the option. Well, think about what you'd rather do.
Yep.
Would you rather buy the option or would you rather buy the stock? If you buy the option at that point, at that level, at that price point, you're not really paying anything over for the cost.
Correct. And everybody thinks, oh, I've paid $476. I lost $476 on the option. It's not an option there, people.
No, it's just
cost to carry.
It's the cost of the money. It's a
cost of the money
for people because it's like, but is it really a cost? Well, it's like, look, you're not spending money on the stock. So what are you going to do with the money? Right? You're supposed to take that money and put it into a risk-free rate of return.
Right. Theoretically, that's the money you're earning by not buying the stock.
Yes.
So yeah, it's a benefit. So you got to pay for it. So you're picking up $476 in your money market. You're spending $476 here. That's a wash. It's got nothing to do with the option.
Now, if you spend it on a new car, that's like
a different story. So let's put this to the test, Stu. Let's put this into a pricing model here. We've got the stock and strike at 100, 360 days to expiration. I'm going to give it 20% volatility, interest rates of 5%. Look at the price of these options. Misperception. What do you notice between those two prices?
Well, I noticed that they're not the same, but I'm kind of wondering what's going on here. If I have the stock at 100 and I have the strike at 100, and, I guess in real life, you could flip a coin and say, which way is it going? Why is the call so much higher?
So much more.
Or I could say, why is it so much lower? It's the same thing. Right. But, I'm kind of thinking they should be the same.
Yeah. And this is where traders will go, oh, I lost 1033 on this option. Well, not really. You lost more like 557. The 476 shouldn't really count. That's what we're trying to show you. This is where people make their mistakes. Now, we put it at 20% volatility. Turns out it doesn't really matter what we chose. But watch this. We could look at this another way. What if we made this a completely non-volatile stock? Pricing model won't let you put zero volatility, but let's make it close to zero and say it has a volatility of 1. Stu, what do you suppose that call option's worth up there?
How about 476?
Part of it he saw over here. The option is worth how much? Because he's looking at the put. The option is worth 0, the volatility component, but we know it's got to be worth the cost of carry, and the pricing model says 476. You can't escape it. It's still a 476 difference. We can go to put call parity. We've talked about this little equation that we use in options trading a lot. There's your put call parity formula. There's the present value of the exercise price that Stu was talking about. Now, on the previous slide, the stock was 100, but it was 557. We add those together, subtract off the calls price, comes up to 95.24.
Now, it's Bill. I know that everybody out there is thinking, oh, Stu saw these slides. Stu knew what the answer was. And I can tell you that is 100% not the case.
No. I try to stump them. I really do, people. I try to put
it's not because I'm a genius. Bill is the genius. Bill is the smartest guy on the planet.
No, that's not true.
I am a guy who's been in this business a long time, and I understand what an option is.
Right.
And you have to work in it's the business of money. It's really the flow of the money and what is the money worth? See, not like what is its price, but what is its worth? What is the money's worth?
Yep.
So you have to take the value of the money out into some future date because these are expirations that occur not today, but expirations in the future. What is the future value of that? And that presents a dollar amount based on whatever the interest rate was. In the last 6, 7 years, it didn't really matter because we had
we're at 0.
Right. But think about how much of an issue this was when we were first trading options in the early 80s when we had 60%,
15, 18%.
I mean, it was like nuts, and they went down to 10 and you thought you were a genius because you were buying the bottom. Well, hello, that's that's another story. We're talking about row risk here, but the option itself has a value. It's based on the value of the money that you're not spending. In this particular example, the call side, it's based on the money that you're not spending. You're supposed to take that money and put it into a risk-free rate of return. That's what these models are built on, risk-free rates of returns.
Right. So now we know, I know we didn't talk about it here, but this put call parity, this little equation here shows that it's guaranteed to be worth the exercise price in this case in 1 year. So if it's going to grow to 100, what's your profit? What's the difference between those two? There it is again, 476. We can't escape it. In fact, Stu, I know you just bought some T-bills recently. If you bought a 1-year T-bill, 100 face or 1,000 face, so let's say for 100 face, if you could, at 5%, what would you pay for it? 95.24. What would your profit be? 476. You can't escape it. It keeps coming back that this has nothing to do with the option.
It's the value of the money.
Yep.
So you have to work that into the equation. It becomes so in the options world, like Bill's saying here, it's part of that extrinsic value. You got to think about
part of it, but it's not the extrinsic value that everybody thinks it is for the volatility component, right?
Right. There's those two components. Now, on top of that, are we going to talk about that at all? On top of that is the volatility component.
That's the price to walk away. That's something separate.
That's the one where you have to kind of think about, well, do I want to pay that? What's it worth?
Right. Not the 476. 476 should, but for everybody else, this is in the conversation. Right.
Now you think about a stock. Well, like here, it's 105 or 107. I forget what you were using here, right? So, or maybe 100 in this case. What if it's lower? What if it's down? What am I willing to pay over and above that 476?
Correct.
Say I was wrong. Am I willing to pay $1? Am I willing to pay $2? And that 1, 2, whatever it is, 1.5, 2.5, whatever that number is, that's the number that gets measured. It's the common denominator that we call
you can take your pick. You can just go down the board until you find the number that you want, but you got to know to back out the 476. So now sometimes traders will say, well, hang on a second. Yeah, this might sound good, but it's all theory, because if we happen to get a lot of sellers coming into the markets, who's to say that this option couldn't trade for $3? Well, there's a very good reason, especially nowadays with the bots. Let's say that call is trading for 3. We just said it should be trading for 476. What's going to happen? I know Stu knows the answer to this because he worked on an ARB desk. But here's the shortcut. You're going to short stock, pick up $100 cash. That's the price of the stock.
What am I going to do with that cash?
You're going to go buy that call. Notice we're not even using our own money. This is part of the arbitrage. It's self-financing. So now the difference is $97. He's going to invest that at 5%. That's going to grow to 101.85. At expiration, he can exercise the call to close the short for 100. Stock is trading below. He could just buy it in the open market, but that's another story. This is the minimum, and there's his $1.85 risk-free profit. But wait a minute, it gets better. He gets that $1.85 in a year. What's the present value of that? What's today's value? 176. How come he got a profit of $1.76? Because the option was trading for 3, and what's 3 plus $1.76 do? Oh my God, we're right back to 476. The reason you can't escape it, the reason that's the arbitrage profit, is because the call option was underpriced by $1.76. So what's going to happen is all of the bots these days are going to just, to get that ARB, they're going to be after the free money.
350 bid, 375 bid, $4 bid.
Instantly. Yeah, this would last about a half a second.
Half a second, not even. 450 bid. Fair value at 476. I'm out.
Gone. So they're going to pound it and push the price of the call up, this arbitrage, right? Buying the call. And they're going to short the stock, which is going to push that price down until the option is trading for cost of carry minimum. So it doesn't matter how you slice it. We tried to show you several ways here to show it's got to be worth the cost of carry.
Yeah,
and everybody misses it.
It's your finance pressure pushing the option back up.
Yep. So let's take a look at NVIDIA. Speaking of, this was shot a few days ago, but being up big. Let's look at the 280 line. Let's say you wanted to do maybe a stock replacement strategy. We'll just do the top one right here. And people will look at this and they'll say, oh, it's $28 of extrinsic value. Not really. What are we going to look at now? What did you learn? Look at the put side. It's about 14. It's about half. This is really closer to what you're paying for the right to walk away. The other 14 is the cost of carry. This 1387, let's just call it $14, is really where the decision is made, not on the $28. And so if you step into those traps of always looking at this, especially when you start getting into higher dollar stocks, that's why I chose this one, it gets really easy to make these mistakes. So Stu, hopefully we can drive this home, see if they've changed their opinions now. Let's go back to Chalk Talk. Stocks at 100.
Can we go back there for 1 second?
Mm-hmm.
All right, here's a real quick application, people. So you're looking at this and you see it's $28 and you're like, I don't know. But when you work into the cost of carry, which is around $14, all of a sudden it becomes a $14 cost, extrinsic value.
That's correct.
Right, it becomes a now you're thinking, well, maybe that's not so bad. You got super high volatility. This is a crazy stock. Hey, I can still invest in this stock and I can use a high delta option and I can try and pay down that extrinsic value. It's not going to take me $28 to pay it down. It's really going to take me
exactly. That's a very good example where people want to do diagonals and they'll say, oh, I got to pay down 28. Nah, it's really more like 14.
Yeah, right. So, that's part of the decision-making process, but you got to have the right information. Looking at $28 is the absolute wrong information.
It's a wrong answer.
Even though it's right there in front of you, right? It's
right. And even though it's in the column that says extrinsic value, it's not really the way you want to look at it.
The platform's lying to you.
Okay, so let's bring it all home here. Hopefully they learned something. Remember, stock was at 100. This is our Chalk Talk. Interest rates at 5%, 1 year $100 call trading for 5. So I want you to think now, how much is the option? And I've highlighted that in red to mean the right to walk away. So what do you all think? What do we say? If interest rates are 5%, the future value is $5. That's $100 strike at 5%. Think of investing $100 at 5%. That's the future value though. What's today's value? $5 divided by 1.05, which we found out was 476. So if you're paying 476 for the cost of carry, which we don't really pay attention to, we ignore it, how much is the option?
Looks like 24 cents.
That's all it is, 24 cents. So if you answer that it was 5, it just shows that you're making bad decisions because you've got misperceptions in the prices versus the values.
So think about this. Is that a cheap option?
Oh, it's not even an option.
It's pennies.
Or pennies.
If you have an interest in the upward trajectory of this stock, and this was actually priced this way, which it never would be, really.
Correct. That's another thing to look. What would that tell you about the volatility of this stock?
It's not going anywhere.
It's not going anywhere. That's why the market's pricing the right to walk away at 24 cents.
Which is exactly why you need volatility in the marketplace.
Yep. And so if you're finding out that we can make money with the volatility, but I don't know how to manage the risk and to structure the trades, also probably because you're looking at the prices and values incorrectly, please check us out. marketrebellion.com/get started. We hope you learned something from that today. And please invite other trader friends. We're really trying to grow this channel. We'll be back next Thursday. And Stu, maybe we should do puts next time.
Yeah.
I don't know. We'll talk about it.
Idea. Yeah. Mm-hmm.
Yep. But it'll certainly be something that'll be worthwhile.
Just a twist on the same idea. So it's not really all that
working in the other direction.
Yeah.
So again, we hope you learned something and wishing you a great upcoming weekend. And we'll look for you next Thursday, 4 p.m. Eastern. We'll see you then.
Adios.